And I think we're live now. So fantastic. Looking at the health of the stream. Looks good. Looks really good. Excellent connection. No background music today because I think it just ended up being a distraction. Might bring it back again later if you all say, I really miss the background music. So, first thing is first here. My good friend Stabulo, fellow member of the MPW cult, was looking at Estee Lauder, wondering what a cigar butt price would be on this. He was saying he feels the 33 billion market cap is criminal. He may have meant in terms of it being too cheap. Personally, I think it might be too expensive. This is one of those where it seems like maybe there's a family that kind of owns the majority of the voting, and there's maybe some infighting, some Nepo babies maybe running the show. So, not necessarily what you want to see. So, from adored to rejected. So they're clearly like a beauty / maybe fragrance type company. I don't know much about these categories. I don't use them myself. I know that's hard to believe, but it's the truth. My mom probably had some of these products in the house when I was a kid growing up, but that's about the extent of my experience with them. So, on the financials, okay, so we don't really have anything in the way of consistent revenue growth. It's up and down, so probably somewhat cyclical, but like overall kind of seems like if you go from here to here, it's basically a flat line. So not exactly something where I think you can expect a tremendous amount of growth going forward. And if it's not a very well-run business, you have a poorly run business with no growth. Now, there's something that's encouraging about the company, actually. I looked at it a little earlier. So their gross margins tend to stay in the high 60s to low 70s, which is quite good. Now, the problem I have, though, so these are margins that are, you expect this to be like either a software company or tobacco company based on how high those margins are. But it really seems like it doesn't quite translate to the bottom line very well. Look how inconsistent their operating margins are. In fact, if anything, they've deteriorated. You know, some of the ups and downs were kind of normal, but like I think the average back from 2019 all the way through 2021 was higher than 2022 through 2024. So it seems like they're getting worse. The free cash flow hasn't changed all that much, but it still bounces up and down quite a lot. So, hey, buddy, I will get to, I'll do Walgreens right when I finish Estee Lauder here. We just started, and I plan to stay in the stream for probably a good 30, 40 minutes total. So we're early moments still. Now back to what I was saying on Estee Lauder. So I would expect if their gross margins are this high and their operating margins are this low, there has to be something going wrong in the middle there with how well they're managing the company and how efficient they are at operating their business. And if leadership is basically decided by a family that inherited their shares, basically, and it's a bunch of nepotism involved and cronyism involved, then and not merit, right? Then what reason do we have to think that they're going to improve and translate those high gross margins into a better bottom line over time? That could be. Again, this is kind of my 5-minute assumption based on just looking at what the numbers show. I would be curious. Actually, I should look at I am curious what their SG&A is. Oh, well, Stabulo, I think we figured out where the money's all going. Their revenue is high threes, low fours in billions. Their SG&A is eating up about $2.5 billion a quarter. Yeah, that's horrific. Yeah, I wouldn't touch this. It's pretty bad. But maybe it's one of those things where they have to spend that much on SG&A to get people to buy their products. But if so, I just don't know if I like it at all. Yeah, they throw everything into SG&A. I don't like that. That's actually one of my problems with Oatly, which is completely different. But they throw so much into SG&A. Yeah. So you were wanting Walgreens, huh? So this is rough. So I used to have Walgreens. I don't anymore, and I'm kind of glad. I got out when it was still around $12 a share. But it was like a 60% loss or something for me. So yeah, not great, but a lesson that I think needed to be learned. So let's see. So surprisingly, and I don't know what this random blip is here on their revenue. I don't think they had a quarter with zero revenue. So I think it's probably a data feed error. But I mean, their revenue is slightly up over the last 5 years. Probably more due to inflation than anything else. But at least it's not going down, I guess. But yeah, gross margins are down. And here's the thing, with something the size of Walgreens, going from like a low 20s gross margin down to like a 17 or 18, it's a big problem because we're talking about $37 billion in a quarter in sales. So those couple percentage swings over the course of a year translate into billions of dollars against the bottom line. Not good. Not good at all. And they're giving up, it seems like, on Village MD, which not a fan of that. Well, if it's not working, I suppose it's better that they give up on it. But I had hopes for that in the beginning, and that hope is now gone. It was one of the things I thought could revitalize their business. Seems like it's not going to happen. I mean, look at this pathetic. This is what a 2 or 3% drop in gross margins can do to their free cash flow. Take it from, low to mid single digits down to negatives to even lower single digits, barely 1%, 1.5% in a good quarter. That's terrible. They could rebound, but the store closures, the fact they're giving up on Village, it seems like they're just trying to survive. That's what it seems like to me. Yeah. Oh, Oh, to be the analyst that thinks Walgreens is going to be $30 in a year. That must be nice to be that optimistic. If I really, and at one point, I would have said I throw my lot in with this $30 target. You know what? I actually misread the WBD as WBA because WBA was in the description on the video, so I thought you were wanting me to skip to WBA. So that's fine. We can talk about WBD in a minute. So, yeah, anyways, to be the guy that thinks that Walgreens will be $30 in a year, I wish I had that optimism. At one point in time, I might have bought that idea, but no, I've got no faith in their management. They don't seem to really have an actual plan. It's just trying not to go bankrupt at this point, I think. So as far as WBD, I actually had this stock recently. I broke even on it, both bought it and sold it pretty close to the $8 mark. Now, the only reason I got out is because I was planning on moving into both Amazon and Disney. And at the time, I had Comcast and Warner Brothers and Paramount, and it seemed like I was getting way concentrated into television and streaming and movie studios. So just to be a little bit more focused, and because I had such a small amount of it anyway, I just got out and focused into Amazon and Disney. I still have my Paramount because that whole merger thing is playing out still. And I want to get the $15 for like half of my shares of that, which after that takes place, I might consider going back into Warner Brothers because, like you say, it seems really cheap right now. Yeah. And here's the thing, this high of 19 doesn't seem unrealistic based on their cash flows. Let's see. They have, yeah, I mean, their cash flows still look pretty good. They're going to have ups and downs, of course, because it's capital heavy. They have to spend a lot of money to make money. Yeah. So that's a good point. One thing I liked to see, they do have a lot of debt, but let's see, where's the long-term debt? Long-term debt. Okay. So, when they first did the merger, okay, so for anybody that isn't aware of the story of, all right, so this jump in debt wasn't the company taking on more debt. This is pre-merger. So, Time Warner got spun off from AT&T, and they sent about $40 billion of debt along with it, which is where this jump came from because it merged with Discovery after the spinoff. So spun off, merged with Discovery. Boom, they've got, the combined entity has $51.3 billion in debt. They, over the last couple years since then, have systematically paid down darn near $15 billion worth of that debt. Now it's down to $37.3 billion. They're slowly chipping away at it, right? They've basically knocked out That's what, about 25%, something like that, of this debt. Close to a third of it, actually. They can definitely manage the debt. They seem to be doing a good job of it. And if the maturities are spread out and it's not just a big debt wall, then most likely it's they're in a pretty, I don't want to say super safe, but pretty safe situation. Especially with rates potentially coming down soon. I think they're situated well to manage the debt. And I think some of their IP is pretty top notch too. Yeah, Walgreens is, it's bad. It's bad. But Warner Bros. I do like. No, so I understand that some of their losses are things like impairments or whatever, but yeah, it really doesn't look good. They could turn it around and recover, but the deterioration of their margins is concerning. And also the shoplifting and such, I think they're taking some pretty big losses from that too. Every retailer out there pretty much has to survive in a post-Amazon world. And I don't know that Walgreens is well positioned to do that. And Amazon's getting into the pharmacy space now too. And then you've got Mark Cuban's cost plus model entering into the fray. Now, CVS at least has Aetna. Yeah, so Warner Bros. Discovery, they've got HBO, which they have some of the most popular series of all time, some of the most award-winning and beloved franchises. Like, they've got The Sopranos, The Wire, Oz. Those are kind of what they built their brand on. And later on, of course, Game of Thrones, which was huge. And now the spin-offs from Game of Thrones, like House of the Dragon. So, yeah, Warner Bros. Discovery has some pretty good stuff. And it's iconic enough. I would say, as far as like the depth of the library of their IP and like the prestige associated with it, they might be second only to Disney. Yeah. Yeah, I'm not I'm not going to try to defend Walgreens by any means. I think the problem with Walgreens a couple years ago is, one, it was a dividend aristocrat. It looked like it had a modest payout ratio. They may have actually benefited some from COVID because people still had to like do all their tests, and you could do the Walgreens drive-through COVID test things, and they got a lot of revenue from that. But they didn't have to deal with people coming in the stores and shoplifting so much. And then that stuff kind of went away. They had probably the wrong CEO for a good period of time. The new CEO might have been right, but at the wrong time. I think Celsius, if it gets cheap enough to where maybe Pepsi wants to acquire them, I think that might be interesting. But yeah, Warner Bros. Discovery, I think, has a lot of positives going in its favor. And look, price to free cash flow of 3, that seems like outrageously cheap. Now, granted, enterprise value to free cash flow is 8.6. So a lot of people, because of the debt, would prefer to use the enterprise value number for like the quote unquote real number. Yeah. But even still, like I think 8.5x for Warner Bros. Discovery is pretty cheap. So even if you use the enterprise value number, it's not like crazy expensive. And also, I think it sort of downplays a lot of their sort of intangible value. Because, yes, of course, a lot of what they own is not like physical assets. A lot of it's going to be like intellectual assets and goodwill. But I think a lot of that stuff does have, a lot of those franchises or those brands, they have value. So it's not as though their goodwill is necessarily worth 0, which is kind of what you imply if you just go off of enterprise value. Not that I think they should actually be selling themselves for pieces. I think they are better as a whole combined entity. They have a more compelling offer on streaming with the combined entity versus if they were split up into pieces. So they're better off staying as one entity. And honestly, they're cheap enough that it wouldn't shock me if somebody targeted them for acquisition. I mean, it happened to Paramount already, right? With Skydance, which don't love that deal necessarily, but it's the deal we've got. But you could definitely see something like maybe an Amazon or maybe an Apple if they wanted to improve their streaming offer. They might want to pick up something like this. Yeah. Yeah, I mean, AT&T is going to do well right now because people are anticipating rate cuts and AT&T pays a pretty stable yield. So anything that pays a steady and relatively high yield is going to probably benefit when rates start getting cut because those assets start to look more attractive. Speaking of streaming and everything, Paramount is one I wanted to look at real quick. So I have, like 600 shares of this thing. And I've just been brutalized. I think, yeah, my cost basis is somewhere in the like 1350 range. So, yeah, it's been pretty brutal. I can definitely at least say that I got in at a better price than Berkshire, who I think got in at 28 or 29. But either way, it's tough. Paramount's tough. It was really more about all the acquisition offers they were getting and hoping one of them would stick. But they picked the one, of course, that's best for Sherry Redstone and worst for the Class B shareholders. So with Paramount, I'm basically, when Skydance closes, I'm guaranteed to be able to get 15 a share for half my shares. So I would much rather wait until that point to dump for WBD. I don't believe that the price of WBD is going to substantially improve before the Skydance merger closes. So I'd like to at least take what I can get and maximize what I'm getting from Paramount. So here's the thing: David Ellison's going to be the new CEO of the Skydance, the new Paramount after the merger with Skydance. But it's not going to be a complete buyout though. They're only letting people cash in half their shares for the 15. But I think it's worth it if you believe that David Ellison is going to be a better CEO. Is he going to run it better than Sherry Redstone and her like friends and cronies, basically? So, I mean, I was told first half of 2025. The exact date depends on regulatory approval, I think. Now, I think regulatory approval will be fine because Skydance isn't that big and neither is Paramount really. It's not as though Disney is trying to buy them or something. Disney's the one where if they try to buy up any more other big media companies, they might run into some trouble. Yeah. I think because this one is smaller though, I would even say Skydance Paramount is even smaller than Warner Discovery. I think the approval will be a little faster. But that's just a theory, my opinion. Yeah. So that's pretty much where I'm at with Paramount. I'm just waiting on that to close. Take my 15. I might let the other half ride on the chance that David Ellison is a better CEO. Yeah. It's not necessarily. I mean, I don't know if it's necessarily minimum a year. They're talking about first half of 2025, which would be a little bit less than a year. Yeah, but I mean, maybe Daddy won't let. And I will say this: Skydance is actually. They've produced some pretty good shows. I think they produced Reacher that you see on Amazon Prime, if I'm not mistaken. If anybody's a Reacher fan and wants to fact check me on that, but if they made that show, then I think it's good content. We might see an improvement. And even if he is a trust fund baby, he cannot possibly be any worse than Sherry Redstone. And they're bringing actually he's going to be the CEO, but the different person's going to be president. I don't know, that's kind of weird, but he's a former Warner Bros. Discovery executive who got ousted because of some inappropriate behavior with a female employee. So, yeah, it's interesting. I want to quickly bring up High Tide. This is probably a little bit outside of what most of you are into. It's Canadian, and it's cannabis. And while I do not personally indulge, they are one of the... Oh, look at that. Analysts want it as a strong buy. They are pretty darn profitable in terms of their free cash flow and operating cash flow. So this is a small cap, but presently they're trading at just 7 times free cash flow and 5.7 times operating cash flow. And again, enterprise value to free cash flow is about 8 if you want to factor in the debt they have. They don't have a ridiculous amount of debt. They have about 11% of the market share in Canada for retail cannabis. Their aim is to hit 20%. They're also going to be expanding into Germany, which is the largest economy in Europe, I believe. At least that was true at one point. Certainly one of the largest in Europe, but I think it is number one. So that's interesting. Now, we also have an election in the U.S. They do have ambitions on coming into the U.S., but recently rescheduling to Schedule 3 in the U.S. for cannabis, which is this whole administrative, bureaucratic hoopla, basically, got pushed back to December. So a lot of people think that it's going to be this dangling carrot and that it's not really going to happen. Though, depending on who gets elected in November, it might be seen as more of a positive or a negative for rescheduling in the U.S. Rescheduling would be a necessary step towards them being able to move into the American market. Because rescheduling would allow more research to be done into safety and efficacy. And if you can't research something, which is something you can't do with it being in Schedule 1 with like heroin and meth, they don't let you even use it for research purposes. If it's allowed to be researched, then studies on its safety can be done, which would be necessary towards further decriminalization or legalization. Therefore, a necessary step towards them being able to go into the U.S. market. However, even without the U.S., they still have almost double in terms of growth to reach just in Canada, which is their primary market, and then they have Germany opening up to them soon. So they don't need rescheduling. They don't need the U.S. They are still cheap in terms of cash flow, and they still have a lot of growth runway before we have to worry about where they're going to get their next growth from. Which CEO is it that seems toxic? Do you mean, are you talking about High Tide's CEO or one of the other ones? Oh, Paycom? Yeah, I don't know. I don't know much about Paycom other than Dividend Dude's really into it. And, yeah. Yeah. Like, Paycom looks interesting, maybe. But I haven't really had the time to look at Paycom. Now, other thing that's down today, cigar butt prices. Cigar butt prices for a non-cigar butt stock is, of course, one of my favorites, Amazon. What's not to love about Amazon? Yeah. So dividends, they're nice in terms of you can let them stack up for a while and it gives you a little bit more dry powder to use on stuff. Definitely don't plan on retiring early on dividends or doing a financial independence retire early thing or anything with them like everybody seems to think. That's like a really popular lane on YouTube. But okay, so a lot of people say Amazon's expensive. I would have agreed with you a year or two ago probably. But every time you say it looks expensive, you're really looking at PE or free cash flow at any point in time. Yeah, on the surface, 41 PE seems expensive, and a 38 price to free cash flow may seem expensive, but they have a lot of CapEx, of course. We know this. And all they need to do is pull the lever of reduce CapEx. Right now, they're at 17 times their operating cash flow. If they pull the lever of pump the brakes on CapEx for a while, and operating cash flow keeps growing some, you have a very cheap stock, actually. Because operating cash flow, if not for CapEx, becomes free cash flow. So in terms of the cash that their operations produces, we're actually at what I think is a pretty modest multiple for a company like Amazon that's growing cloud at such a speed. I mean, hey, yeah, if 145 is your price, by all means you're entitled to wait for that. I actually think there's a chance that we don't see prices below 160 again anytime soon. Even at today's prices, yeah. It actually, AWS is used where I work too. So yeah, Amazon is a powerhouse in cloud, and that is still growing quickly, and that is very high margin. Now, there is the thought that since cloud is high margin, a lot of other competitors will want to enter into that space because chasing those high margins, which will cause competition, which will drive down the margins. Now, that I don't think has really played out as of yet. That's just what people are projecting into the future as a possibility. But I think demand for cloud is going to go up enough, maybe that, the rising tide lifts all boats. And I don't think it's one of those things where just any old company can just all of a sudden be like, we are in cloud now. I think it takes a bit of cost to get it rolling. And Amazon is one of those companies that had the Bezos bucks to do it. But that's just, yeah. So 100%, I think 3 or 4 years down the line, we'll be looking and saying, I could have got Amazon for 17 times their operating cash flow back in 2024 on a little pullback. What on earth was I thinking not buying it? Now I am and do, but I think even here right now, it may be even more obvious of a deal than it was when the share price was like below 100, during that late 2022 crash. Because at this point, they're able to show enough of their profitability that it's like, okay, actually they have something to back up this share price. It's not just what we think they can do. Lululemon, okay. Speaking of that, give me 1 second here. So Lulu. Interesting. Do we think that they're going to keep growing? This is the thing. So I'm not in Nike. I'm not in Crocs, even though I thought Crocs looked cheap when it was in the 80s. I didn't get in. I struggle a little bit with apparel, fashion, that kind of thing. And so what is it that sets this apart, makes it sustainable, long lasting, all that? Granted, yeah, if they can produce continued growth, even if it's not as much as what they were previously producing, maybe. But what is to say the next big, the next Lululemon, the next whatever, won't come along and start nibbling at their market share? Fashion to me, like, just seems like it's so fluid, like what's in today won't necessarily be in 5 years from now. But yeah, it seems like it's not crazy cheap, but not crazy expensive. It's kind of halfway in the middle. So it might be more or less fairly valued, but where's your margin of safety? Now, if it grows even moderately well and isn't replaced by the next big thing, you could probably do well for a while on it. But yeah, my sense of these things, like, I don't think I have a sense of these things. That's the problem. Like, the next big thing could come out and I wouldn't know about it for years because I'm just not into this kind of stuff. So there could be a big old freight train headed in to steal all your market share out from under you. I would never know about it with this, unless it was mentioned on an earnings call or something. It's just like, what's defensible about it other than the name? Like, you can't slap this name on another pair of whatever kind of clothing they sell. That's the tough part for me. Like, it doesn't look bad valuation wise. It doesn't seem ridiculous, at least. But yeah, I struggle. I struggle to know when it would be a good idea to maybe, jump ship and cut and run because of the next big thing coming to replace them. I get why people like it. It hits some kind of a gap in the market, or some kind of perceived gap in the market. But there's always going to be somebody else coming in, not whether they be knockoffs or just the next big thing. I mean, but then again, there's Nike has survived countless up and comers in their space as well. But I wouldn't buy Nike either, to be honest, because it's like kind of expensive for a shoe business. Yeah, it's a matter of the preferences seem to change over time. And if they do become, a really, really well-established brand that is rock solid and steady and an institution, well, at that point, they'll probably have minimal growth left in them anyway. And I don't know. I don't know that there's a place for this type of thing in my repertoire. Snow. Is that Snowflake? Cloud-based data platform. Oh, they mention AI in the description. It's going to be a banger. Okay, trading for 10x revenue. Don't actually make money yet. Or maybe they do on a cash. Yeah. Okay, so they are free cash flow positive. Okay. And they're projected to be net income positive next year because their forward PE was listed. Yeah. I mean, if this growth continues, I mean, it doesn't get any more vertical line than this, right? Rich, yeah, we did talk about WBA a little bit. It's just not looking good, to be honest with you. I was in it at one point and got out when it was still around $12. But with WBA, I think the reason the one element of it that I was clinging on to that I thought this could be the thing that helps them right the ship and spark some new growth in their business. They're kind of giving up on it. At least that's the impression I got on the last earnings release. So I thought it over and decided to let it go, even though I thought, hey, this could be the bottom and it could go up again. And that was when it was 12, and now it's below 10. So, yeah, it's not looking good for Walgreens. Yeah, Snowflake. Definitely, I like the way this is going. But the thing that's dangerous about this is sometimes analysts and such get really enthused when the revenue looks like this, that 45-degree up and to the right thing, and they project those 30% growth numbers like basically perpetually into the future, and it can only go on for so long. Now they're not so big because they're not even at $1 billion in quarterly revenue yet. So if they've got a good amount of runway left to at least keep that up for a few more years, then you could see them start to justify this valuation at some point. I mean, the dilution, I'm going to take a guess and say probably stock-based compensation accounts for a lot of that, which is probably why they're able to have free cash flow but not net income. Yeah, I mean, even I would have said a couple years ago, there's no way WBA goes to zero. Now, honestly, and especially after Rite Aid, I could see WBA going to zero potentially. Not that I think that they're necessarily as badly positioned as Rite Aid was, but they're not in amazing shape by any means. And thinking that something being a dividend aristocrat even means anything, that was definitely a mistake. Interesting. So funny thing here about Snowflake, their gross margins are decent, in the 60s, the upper 60s, lower than Estee Lauder's. But I have the feeling that over time, their free cash flow, operating margins, and profit margins are going to be a lot more consistent. Just a feeling. And I'm going to guess because I'm going to go ahead and assume they probably don't have a lot of debt. Yeah, no, their balance sheet's good. $3.6 billion in net cash. So yeah, Snowflake's probably pretty well positioned. I just don't know how long the 25, 30, 35% growth in their revenue is sustainable. That's always tough for me with these high-flying, fast growth type companies. Knowing how long it's going to continue into the future is tough. And if you assume it's going to go longer than it does and you overpay, you can get burned pretty bad. But I think if you can safely say that it's going to go for at least like 3 or 4 more years, they could grow into their valuation at least by that point. and you might not get singed, even if it slows down in a few years. I would definitely just look into how big the addressable market is, what the landscape is, and like kind of how much that addressable market might be set to grow. I don't know the answers to these questions offhand at all. It's just some stuff I would maybe try to think about. Yeah, it's and if the growth sustains for a while, it doesn't seem unattractive. So that would be the thing I would focus on, is what do I think the growth is actually going to be, especially over the next 3 or 4 years, if you plan to hold it for that long. Maybe. And that's the other thing. It's difficult just based on like a quick reading of this description to to really be able to define exactly who their customer is or what exactly they solve for their customers. And I've never looked at Snowflake prior to right now. So, I mean, I've heard of them. I've seen people bring up the ticker before, but I've never listened to an earnings call, never gone to their investor relations part on their website, never even went to their website at all to see even what they offer to customers. So very minimal knowledge here. So what I'm saying is just based on the numbers in the data feed. Keep that in mind. So, all right, I am close to the hour mark, and I gotta actually head into the office soon for some work, unfortunately, as I still do work for wages. So with that, I do want to remind everybody that I do have a Discord linked in the description. Stabulo, who was in here earlier, Leaf, who's in here right now, both in that Discord talking stocks a lot with me and with the other 100 and something people we have in there. It is 100% free. I will never, ever charge you for it. I do have channel memberships, but those are just to support the channel of your own free will. Lowest tier starts at $1. Also, on X or Twitter, whatever you want to call that, I do have a goal of reaching my first 500 followers. I am 300 and something of the way there. So if you want to follow me there, that link should be in the description as well. Yeah. You still can't join what? If you're having trouble with the Discord, leave a comment maybe after the recording is available on YouTube. I appreciate that. Analyze stocks. By the way, you'd be more than welcome in the Discord. I think you brought up some interesting points here in the conversation. So if you're not already in there, we'd love to have you over. But yeah, I mean, that's all my plugs. If you haven't already, jam the like button so people will find this later, and go ahead and subscribe. But yeah, if you're having trouble with the Discord, I don't know, we'll try to figure it out. If you I don't know if I don't know if I want to encourage you to leave your Discord ID in anywhere public, because then you'll get spammed to oblivion. But I definitely want to see if we can help you get in there. If you have X, aka Twitter, find me on there, and I'll private message you, and we can get your Discord ID on that platform, and so that we can just direct message, and I'll get you into. I'll send you. Maybe I'll make a fresh link or something and get you into the Discord. Anyways, guys, I gotta hop. I definitely appreciate everybody watching. Take it easy, and I might do it again tomorrow.